Using AI to flag overvaluation. Using AI to evaluate whether a stock is potentially overvalued involves combining traditional valuation techniques like analyzing financial ratios with advanced data-driven methods such as machine learning algorithms. Below is a step-by-step overview of how you could approach using AI to assess stock valuations. 1. Define the objective. Overvaluation versus fair valuation. Clearly define what you mean by overvalued. Are you looking for a price above the intrinsic/fundamental value? A stock trading at higher multiples compared to peers? Future returns expected to be lower than the risk level justifies? Time horizon. Decide if you are looking for signals relevant to short-term trading, days/weeks, or long-term investing, months/years. This will guide what types of data and models you use. 2. Gather the data. Fundamental data. Collect financial statements, income statements, balance sheets, cash flow statements, and key metrics such as price/earnings, PE ratio, price/book, PB ratio, price/sales, PS ratio, debt-equity ratio, return on equity, ROE, earnings growth rates, market data. Gather historical prices, volumes, and technical indicators, e.g., moving averages, RSI, MACD. This can help you identify market trends and patterns. Alternative datasets, optional. News and social media sentiment. Use NLP, natural language processing, to gauge market sentiment from news articles, social media, e.g., Twitter, Reddit. Macroeconomic indicators, interest rates, inflation rates, GDP growth, unemployment levels, etc. Analyst forecasts. If available, collect analyst price targets, earnings estimates, and buy-sell ratings. These can serve as benchmarks or features in your model. 3. Data preprocessing and feature engineering. Clean and normalize data. Ensure consistent date ranges and time intervals, daily, weekly, quarterly, etc. Handle missing values or outliers, e.g., forward fill, interpolation, or removal. Feature engineering. Ratios. Compute derived ratios, PB, PEG, PVAS, etc. Moving averages. Calculate short and long-term moving averages to identify trends. Sentiment scores. Use NLP models like Hugging Face transformers or custom sentiment analysis libraries to generate sentiment scores from textual data. Macro aggregations. Summarize macroeconomic data into leading indicators, e.g., Consumer Sentiment Index, PMI. Dimensionality reduction, optional. If you have a large number of features, techniques like principal component analysis, PCA, can help reduce complexity and noise before modeling. 4. Modeling approaches. There are multiple AI or ML approaches you can use to determine if a stock is overvalued. Below are a few common examples. A. Supervised learning for intrinsic value prediction. Label definition. You need a ground truth label for whether a stock is fairly valued or overvalued. Some investors use future returns as a proxy. If returns underperform a benchmark, e.g., S&P 500, over a certain time frame, they might label the stock as having been overvalued at the time. Regression models. Predict a target variable like expected future returns or fair value price. Examples of models. Linear/logistic regression. Random forest regressor. Gradient boosted machines, e.g., XGBoost, LightGBM. Neural networks. Classification models. Simplify the problem into a binary or multi-class classification, e.g., overvalued versus undervalued versus fairly valued. BEAS, unsupervised learning for outlier detection. Idea. Overvalued stocks can be viewed as outliers in terms of valuation metrics relative to peers. Methods. Clustering, k-means, discan, to group companies with similar profiles. An outlier within its cluster in terms of price multiple might indicate overvaluation. Autoencoders to detect unusual patterns in financial data. C. Reinforcement learning. Idea. A reinforcement learning agent can learn which stocks to buy/hold/sell based on rewards, profits. If the agent consistently avoids or shorts certain stocks it identifies as likely to drop in price, those could be considered overvalued. Challenge. Reinforcement learning setups require detailed simulations or real market interactions and can be more complex to implement. 5. Model training and validation. Split data. Divide your dataset into training, validation, and test sets, e.g., 70%/15%/15%. Train and tune hyperparameters. Use techniques like cross-validation, grid search, or Bayesian optimization to tune model parameters. Evaluate metrics. Depending on your approach, regression versus classification versus RL, look at metrics such as regression, RMSE, root mean square error, ME, mean absolute error, R superscript 2 score. Classification, accuracy, precision, recall, F1 score, AUCROC. Trading strategy, Sharpe ratio, maximum drawdown, annualized return, etc. Avoid overfitting. Use regularization and proper cross-validation to ensure that your model's performance is not overly optimistic. 6. Interpreting results and making decisions. Rank stocks by valuation score. If your model predicts a fair value or a probability of being overvalued, create a ranking of stocks to identify which ones look most overpriced. Validate with fundamental analysis. Cross-check AI-generated signals with fundamental analysis, e.g., has the stock's P/E ratio diverged significantly from its historical average or sector average? Combine with risk management. Even if a stock is potentially overvalued, consider broader portfolio risks, position sizing, and stop-loss strategies. Monitor and update models. Markets change, so continue retraining and fine-tuning your models periodically. Reassess which features or data sources are still relevant over time. 7. Practical tools and frameworks. Data collection and wrangling. Python libraries. Pandas, NumPy. SQL/NoSQL databases for large datasets. APIs, Yahoo Finance, AlphaVantage, Quandl, and various brokerage APIs. Machine learning. Scikit-learn classical ML models. XGBoost, LightGBM, boosted trees. TensorFlow, PyTorch, neural networks. NLP and sentiment analysis. Hugging Face transformers, BERT, Roberta, GPT. NLTK, Spacey, Flare. Model deployment, Streamlit, Flask, or Fast API to build dashboards or APIs. Cloud services, AWS, Azure, GCP for scalable deployment. Key takeaways. Blend AI with fundamentals. While AI can detect patterns quickly, grounding your analysis in time-tested ratios and fundamentals helps interpret results meaningfully. Quality of data matters. No matter how advanced your model, poor data quality or incomplete features can lead to misleading conclusions. Continuous improvement. The market evolves. Your model should be updated regularly with new data and insights. Using AI to flag overvaluation is about probability and not certainty. It should be part of a broader investment or risk management strategy rather than a standalone green light/red light. By systematically combining fundamental data, technical indicators, and alternative data sources into a robust machine learning framework and validating against real market performance, you can gain powerful insights into which stocks may be trading above their true worth.